Good morning, everyone, and welcome to our latest in our series of Retirement Plan Academy. My name is Zach Hurst. I'm with the Trust Company of Tennessee. Alongside me, you'll see Kevin Fillers on screen, who's a colleague of mine, and our featured speaker here, Eileen Ferenzi, an attorney out of Atlanta, who's going to talk to us about IRS audits, among other topics today. But first, I wanted to, before I get to intros, give a couple quick housekeeping items and updates. Some of you qualify for SHRM or HR CI credits, and if you do, we'll be sending you codes for those following this webinar, so stay tuned for that. Also, you're going to see in your tab here, there's a questions box. Feel free to ask any questions of any of us as we go. Hopefully we can get to them as they come in. If not, we've certainly reserved time at the end for those. So with that, Eileen, Kevin, if you're ready, let's jump in. And I'll spend just a little bit of time on us, the Trust Company of Tennessee. We are a retirement plan provider throughout the Southeast and across the region. I work in the Chattanooga office. Kevin is in our Knoxville office, which is headquarters for us. We serve as a 338 and trustee on retirement plans, and we probably have clients on this call, so welcome to all of you. Kevin, enough about us. Let's get to our featured speaker today, Eileen Ferenzi. Eileen is an attorney out of Atlanta. Eileen, I'm going to use a cheat sheet, but keep it simple for you and let you tell us a little bit more about your day-to-day. But Eileen is a former third-party administrator for those plan sponsors on the call. We certainly work with those in some capacity. Also a nationally recognized speaker and author. And Eileen, you focus your practice on all types of employee benefit plans. So instead of me trying to read off all that is, what does your sort of day-to-day or week-to-week look like?
Oh, we are consulting attorneys, so we don't do a lot of litigation, but what we generally do is help employers keep their plans compliant. We do a lot of corrective work so that when somebody finds that they have a problem, we help them fix it and get their plan back on track. And we also represent clients in various audits and other kinds of confrontational situations with the government when that comes up.
Got it. Thanks. And thanks for being here. We're excited about this and hope everyone is as well. I think we're going to get a lot of really good information in terms of the IRS. For reference, for those who have been on multiple calls with us, we have done this from the DOL standpoint today. We're going to get an IRS today in terms of the audits and do a little comparison of those. So let's start with a fun little poll question for the audience. Here's the question, but we're actually going to launch it on your screen so you can interactively answer along with us. The question is, which audit do you think is typically more difficult? Is that the DOL or the IRS? And I believe we're going to have a pop-up in a minute to see if this poll opens. And so there you go. Let us know what you think. Eileen and Kevin, I would ask you, but that would be cheating. I think you both know the answer to this. Eileen, I hope you know the answer to this.
I hope so too. But you know what the real answer is? Whatever audit you're in the middle of.
That's exactly right. I'm guessing neither are fun. Is that accurate?
Yeah, that's probably accurate.
Yeah. Give you just another minute to answer this, and then we will post results and see how we did. There you go. The majority feel that the more difficult audit is the DOL. Eileen, how do we do?
I think that's exactly correct. The Department of Labor auditors, examiners are almost all attorneys. And I can say, you know, being an attorney, of course, they are difficult to deal with on occasion. They tend to subpoena things. They tend to be much more formalistic. And most important of all, they move at a glacial speed. And so basically, it will commonly be a 2 or 3 year process. They will go silent and deep for 6 or 8 months, and then they'll come back, and just when you think it's over, it's not over, and they get their teeth into very small issues and make big deals out of them. So yeah, generally speaking, the Department of Labor is much more difficult to deal with.
Good. And I think Kevin's going to lead us into a little conversation with you about really the big differences between these two that you just touched on. So Kevin, I'll let you take it away.
Thanks, Zach. So, you know, looking at this slide, Eileen, we kind of look at both sides. So the DOL is more covering the ERISA side, whereas the IRS is looking more at that tax advantage status. So can you kind of walk us through that? I think we have a slide coming up next that kind of breaks that down, but if you can walk us through it, that'd be great.
Yeah, ERISA, which is the law that governs all of the employee benefit plan stuff, gave jurisdiction to both the Department of Labor and to the Department of the Treasury, because Congress recognized that there are issues of tax and tax deductions and taxable income and delaying of taxable income and stuff. And there are also issues of protection of participants. And so they put the participant protection stuff with the Department of Labor, and they put the tax stuff with the Department of the Treasury. And so that means that we have to stay compliant with two different governmental departments. So what we see on this slide is that the Department of Labor is in charge of all the fiduciary obligations to make sure that you're acting in the interest of your participants, that investments are prudent, that you're doing things properly administratively, and that you're not dabbling in transactions that you shouldn't be dabbling in, making sure that people are coming into the plan when they're supposed to come in, that they get benefits when they're supposed to get their benefits, and things like that. The Department of Labor, the Department of the Treasury rather, is pretty much concentrating mostly on tax issues. There is overlap with the Department of Labor, for example, things like discrimination and eligibility investing. The IRS is not willing for companies to get tax deductions for retirement plans if they're not sharing the money with a broad base of employees, and so they will look at some of the very similar things. But when you deal with the IRS, what you're usually dealing with is that very specific tax side. And if they have problems with anything you're doing, what they will do is that they will take away tax benefits.
Which no plan wants, correct?
No, nobody wants that. Nobody wants that.
Thank you, Eileen.
Excellent. Let me get back to my screen. Sorry for that. So we're going to focus today again. We mentioned the comparison between the two. We've really hit pretty hard on, and Eileen, for your reference, I believe you know this, but a few months ago we brought in a DOL investigator, former DOL investigator, who talked through some of that process. But we really haven't heard it from the IRS side, which is a specialty of yours. So I think we would like to start with is how the IRS actually selects audits, and you'll see the three bullets here, the 5,500 review, certain targets, and random. But if you want to walk us through those, Eileen, that would be great.
Sure. So there are certain things that the IRS notes on 5,500s that they've sort of learned over time are signals that a plan has issues. I mentioned here that a large change in the participant numbers without full vesting. If you have a whole bunch of people leave within 1 year or within 2 years, they term that to be a partial plan termination. They want to see that you vested those people who left, so look for that. If that you have, there's a listing, a balance sheet type listing on the form 5,500. And if you have assets that you can't categorize in any of the pre-existing categories, you put them under other. That is another indication to the IRS. Maybe you're doing some investments that might have issues with them. Both the IRS and the Department of Labor are very interested in 401k plans that don't deposit the employee's salary deferrals on a timely basis. And also when they see large distributions going out of a plan, that is something that they look at. And one of the things that happens with the IRS is that they will do other reviews, and we're going to talk about those in a minute. But when they are reviewing people randomly, one of the things that they're doing is looking to see what are additional indicators of problem plans. If they do a bunch of random audits and they find that, out of these random audits, people who check this box tended to have problems with the plans, and they'll use that as criteria down the road for picking out other plans for audit. So this is one of the ways that they choose plans for audit.
Got it. Thanks. And then the second one that we mentioned is certain targets. So what does that mean?
So again, they will understand, they'll hear through the grapevine, or they'll notice in other audits that certain issues become problematic. That, for example, top-heavy plans are not properly giving benefits to people, or that self-employed individuals are continuously miscalculating what their deductions are or how to handle things. So they will periodically announce that they are targeting a certain group of plans or plans with certain characteristics as a way of finding out how people are complying and helping to encourage additional compliance by making them audit targets. And these targets change over time. And so I'm continuously asked, well, if we do X, is that an audit target? And sometimes yes, sometimes no, and sometimes it wasn't yesterday, but it is today.
Got
Eileen,
it.
do you mind explaining what a top-heavy plan is for folks that might not know that?
A top-heavy plan is a plan where more than 60% of the money is going to the people who are basically the owners or the higher-ups of the company. Small, closely held businesses are almost always top-heavy, and you should have, if you're in that category, your plan should be designed to basically take care of that for you. It shouldn't really be a concern. But generally speaking, if you have a top-heavy plan, there are certain minimum benefits that have to go to the rank and file. And again, that commonly is taken care of just as part of your plan design. So it usually isn't a huge area of concern for people if your plan is designed appropriately.
And on the self-employed piece, is that just making sure that anybody with a SEP type IRA or SEP 401k is actually taking care of their other employees, or what's really the focus there?
There's a couple of different focuses. One is that, yes, that they understand that even though they're not incorporated or whatever, they have to cover employees. But a big area of focus is that it's really common for self-employed individuals to calculate their compensation for plan purposes incorrectly. There is sort of a labyrinthine method of determining what counts as compensation for plan purposes when you are a sole proprietor, or even if you're an S corporation shareholder, and people make mistakes on that all the time. So it becomes an area for the IRS to look at.
Got it. Okay. And the third one sounds like a lot of fun, just random.
Exactly. And the IRS engages in, just basically random audits of people. Again, they do this in large measure, first of all, just to encourage compliance. If people felt that, the only way that they were going to get audited is if they looked guilty, then they would go out of their way not to look guilty. So they want to audit people randomly just to make sure that people are sort of behaving themselves. They also are going to do some random audits to get information, as I mentioned, to see what areas of the 5,500 are indicative of problems. And there is some potential of being audited if participants complain. You'll see that more on the Department of Labor side than you will on the IRS side. People don't generally call the IRS in that way, but it's possible that they would. And so, yeah, and one of the things that's really important is that neither the Department of Labor nor the IRS will tell you why you're being audited. So if you say to them, how did this happen? They won't say, oh, because you checked this box, yes, and that we audit plans that check that box. They're not going to do that for you. So you just have to go ahead and put your best foot forward and hope that you basically, dispel any pre-existing thoughts that they have about your plan's operations.
Sure. And one of the things when we had the former DOL investigator on, she talked about was she would, get a notification from a participant out of a plan, and let's call it Chattanooga, where I am. And then basically they say, well, what the heck, we're in Chattanooga. Let's go find 5 or 6 more. Is that kind of what it is too?
Yeah, they do. Particularly if you live in a city where the Department of Labor doesn't have an office. Like they have an office here in Atlanta, but they don't in Chattanooga. So if they're going to schlep out to Chattanooga to go look at one plan, they may as well look at 5. And so suddenly you'll see that there are 4 or 5 other plans that are being audited in that area because the auditor wants to not waste a trip.
Sure, got it.
It also makes it difficult, by the way, for you to reschedule audits in the outlying cities, because they don't want to have to go up there just for you. So if you call them up and say, that's not really convenient, can we do it on Tuesday? They'll say, no, not so much. We want to do it on the day that we're going to be there. Yeah.
I may be. Go ahead, Kevin. I'm sorry.
Oh, I'm sorry. Would you say that we're seeing an uptick in the amount of audits due to the kind of a COVID environment that we're in now that they aren't traveling? These auditors have more time to dig in and review plans?
That's a really good question. I have not noticed that. And I know that there has been a sort of sympathy throughout the government for people in these times. And so I have not noticed any kind of uptick or any kind of, making sure that you're doing the things that you're supposed to do in light of some of the governmental changes for COVID. That doesn't mean that in a year or two that they won't be reviewing everything that happened this year, but I seem to see a much more sympathetic government this year as opposed to a more negative one.
That's the first time I've heard sympathetic and government together, so that's, I guess, encouraging to hear. I'm kidding, but I think we're going to, thanks for the info on that, Eileen. I think we're going to go with one more audience poll question that should pop up momentarily. And here we go. True or false, the IRS believes that most plans they audit are compliant. And we'll give them a minute to answer that. Eileen, is it fair to say that there would be a different answer between IRS and DOL on this question, or not necessarily?
It's hard to know. I mean, they're both there to ferret out issues, but I would tend to think that the Department of Labor is much more jaundiced in their view than the IRS is.
Got it. Gotcha. Okay. So we will trigger the results of that.
You've got a very
true.
Yeah. It's really interesting. I will tell you that the employee plans group at the IRS tends to be, and this is not everybody, but they tend to be sort of an amicable group of people. They do not go into an audit maybe in the same way that you might have had experiences with tax return audits, thinking that they're going to, ferret out all of this, dirty deeds. They understand that you don't have to have a retirement plan, and you're doing something nice for your employees. And so they tend to go into this sort of with an open mind. And I find that it's easier to negotiate with them, or to work with them about issues. Now you always get, there's always the odd auditor, usually the people who are less experienced, who dig in their heels in certain, ridiculous things. But in general, I find that the employee plans group at the IRS is reasonable in general, whatever that's worth.
Sure. So this is what you would receive. This is called an IDR, an information and document request from the IRS. And I think the first paragraph kind of echoes the results of that question. If you look here, that just basically says, the IRS is not implying that you did anything incorrect. You were either selected randomly or part of a special project. So I think that's pretty interesting that they assume that you're compliant until they find out you aren't. And then if we jump to the next slide, this is really the second part of the IDR, and it goes through everything that you're going to need. So Eileen, can you kind of give us an idea of how can we be prepared? How could somebody be prepared in case this does come across their desk, and what they should do?
Absolutely. So a couple of things that I just want to say at the outset. The first thing, and it's going to sound like I'm trolling for business, and I'm really not, but you should not handle these audits by yourself. I get brought in all the time with plans in trouble. And I will tell you that when you're 3/4 of the way through an audit and an issue has arisen, and now you bring me in, it's much more difficult for me to walk back a situation than it is for me to deal with things up front. So I will tell you that do not do this on your own. This is not this, this is like brain surgery, and you don't want to do it that way. So that's the first thing I would say. The second thing I would say is don't ignore these letters. Again, every so often we get involved in audits where the IRS is already angry before you've even started the audit because they've been ignored for 6 months. So that can be an issue as well. The final thing is that if you are going to put together a package for the auditor, you want to do a couple of things that I think are really important in terms of making an impression. You want to convince the auditor upfront that your plan is pretty compliant. And so the way that you're going to try to do that, at least, is you're going to try to be very organized in the way that you provide information to the IRS. In the days before doing things on zip drives and stuff, we used to do 3-ring binders with tabs for each of the questions. So we would have a tab 1, and that would be the plan document, the trust document, and all amendments like it says on the IDR list. And then we would have 2 and we would have 3. And one of the things that we would always make sure to do is if we didn't have something or if it didn't apply, we would put a sheet of paper under that tab that would either say this doesn't apply, or we don't have this right now, we're getting it for you, we'll provide it in the future, or something, so that they would know that we had addressed every single thing that we were asking for. We weren't trying to duck out of something. And it would make it very easy for the auditor to go through things. Nowadays, when we do it on zip drives and stuff, we will number the items on the zip drive so that they can see that we've complied with each of the items. And again, if all we have is a note that says that we don't have that, or it doesn't apply in this situation, we would have a file that would have 1 sheet of paper in it, or one document that would say this item doesn't apply, or we'll get this for you later. And that way, when they go through this list, it's very easy for them to go through and look at everything it is that they want to say. The other thing that we would do is, if you're doing it in hard copy, we would keep a duplicate copy of what we provided to the IRS. We do the same thing with the zip drive. We don't just take files out of our computer file and send it to the IRS, and then later on we're not really sure what documents we gave them. We always make sure that we keep a listing or a copy of what we send them, so we always know at all times what the government has received, and we can go back and look at things. So again, coordination of what you're doing, putting your best foot forward, looking like you're organized, looking like you have your stuff together is really important at this point, because you're making a first impression.
Eileen, I'm thinking about this from a plan sponsor standpoint, and let's assume that I'm the plan sponsor and I receive that letter that we just saw through Kevin, and I've got a TPA and I've got a record keeper and I've got an advisor, and then there are these benefits attorneys as well. Where do I start? What's that process like?
Well, probably what you want to do is pick a quarterback to start with, and that should be the person that you trust the most, to have the most knowledge and the most savvy about this. Quite often that's the third-party administrator, or the record keeper, the person who has all the records and stuff. Other times, you want to put your attorney in charge of it just so that they can keep everybody's feet to the fire, make sure everything gets done on time. But by having a quarterback that you put in charge of the process, you've got somebody who is knowledgeable, who will gather the information from the various parties and put it forward to the government. So that's what I would recommend. And again, at the very least, probably if nobody else comes to mind, your third-party administrator is probably in the best situation to put things together. One of the other we'll mention just really quickly is having somebody look over the information that's being provided to the government in advance to see what issues arise is really helpful, because lots of times you can go into the IRS at the beginning and say, hey, as we were putting together this audit information for you, we noticed that we made a mistake here and we want to deal with that. And that shows the government that you have a culture of compliance, that you are trying to be compliant. And I will tell you that, if you put me in a room with records for a plan, I will find something out of compliance. The rules for retirement plans are just so complex and so labyrinthine that you can always find something wrong. But what you want to do is show the government that you're doing everything you can to comply with the rules, and so they have a good impression of you. So going in and telling them that you discovered something and that you're fixing it and how you're going to fix it is a good way to start the audit, because they know that you're on the ball. So having somebody look at the audit records before it goes to the government, seeing what the government's going to see is really helpful. And so having somebody other than the TPA who is independent, who hasn't looked at these records before, might be a good way to do that, so that you get that same first impression that the government's going to have.
Got it. And then the last of these webinars that we did, I think it was the last one, or maybe 2 times ago, was on the different levels of fiduciaries. And I'm going off course here, but I'm sure you deal with this all the time. Do you, in your role, prefer to come in and see providers who provide some level of fiduciary service, or is it really just a matter of looking at the whole process?
Yeah, it's really the whole process. And with regard to the different levels of fiduciaries and that kind of stuff, I mean, there are a lot of people out there that are saying that they're 316 fiduciaries, and that is a meaningless phrase, really. And what I mean by that is that there's no listing in the law or something that says this is what a 316 administrator does. And so there are various levels of services that those people provide, and some provide relatively little service in that category, and some provide very comprehensive service in that category. So just the fact that somebody's got a 316 administrator doesn't blow my socks off all that much. It's the level of 316 administration that's being provided, and then whether or not they're doing a good job, of course, is also important.
Sure. Yeah, and that's the 316. I think, Eileen, is most applicable to a third-party administrator. Is that accurate?
That's where you're seeing it most of the time these days. Sometimes you see other people doing that, but that's usually where you see that. I'm probably more impressed to some extent by people who have investment managers, just because I am such a moron when it comes to that I have an investment manager for our plan. And if you have somebody who's a widget maker and they don't know anything about investments, having somebody else be responsible for choosing prudent investments is probably a good idea.
Got it. Great. So now we're going to move into the part about how do they actually audit. And Eileen, I found the top 2 bullets here to be pretty interesting, but I'll let you take us through this.
So, the IRS used to, when they audited a plan, they would do this full board audit for every single plan that they audited. And at some point in time over the past, I don't know, 5 or 6 years, they became aware of the fact that they were spending a lot of time doing full board audits on plans that were very compliant, so that they were basically wasting a ton of time picking through the stuff of plans that they didn't need to do that for. So they changed their approach to being what they call focused audits. And what they do is now, when they send out an audit request, they will send out a request for certain documents consistently. They'll always ask for the plan document. They'll always ask for certain information. But then what they do is that they focus on 2 or 3 areas of the plan. And if they look at those areas of the plan and the plan is compliant, they will basically assume that the plan is compliant elsewhere, and they'll move on. So they won't spend a lot of time on a plan that they think is doing well. So the idea now is that when the IRS comes in to begin with, first of all, not every question is going to be, or every list of data is going to be the same from client to client or from plan to plan. But the other point is that you want to look like you've got it nailed to the extent that you can with regard to what they look at so they won't expand the audit. And this is one of the reasons why you want to get somebody involved early in these audit situations, is that once you've given the IRS the impression that your plan is out of compliance, now you're going to be in this full board audit. You're going to be a lot more involved. It's going to be a lot more costly than it would have been had you been able to nip this audit in the bud during the focused portion of time. So if you can go to the next slide.
Sure.
So yeah, so again, your goal is to look really compliant. If you're not in compliance, you want to know that, and you want to consider how you're going to present that to the IRS. We look at things like, gee, this is a problem. Is it discoverable by the IRS? Is it not discoverable? If it is, how can we fix it? And you want to convince the IRS, if you do have an issue, that it's isolated and is not a sign of a problematic problem or problematic plan, and that you guys are on top of things. And again, the IRS knows this stuff is complex, and they know that no employer out there can really be on top of everything. So if you can show that you're doing your best, that's what they're looking for.
I'm actually going to jump back one, Eileen, if that's okay. I just have a quick question on this one. So again, I'm going to reference the DOL side of this, and the DOL, as we understand it, goes in and these auditors work on a point system, right? And this was what was discussed some months ago. But effectively, any type of money transactions is what they were really after. And so on this slide, you talk about 2 or 3 areas that they start with, and then hopefully they don't have to move on from there. And you list in the smaller font eligibility, vesting, distributions. Are there 2 or 3 that they typically seem to focus on to start that we should all be aware of?
Well, the plan documents are a big area, and I have to tell you, this is an area where people who are service providers have not concentrated well historically. The plan document is considered by the IRS to be the Bible of everything that goes on with the plan. And if you don't have signed documents, if your documents are not dated timely, that's an easy thing to catch. It is a first impression. I mean, they will catch that in seconds, and it is easy money for them. They will end up, getting a penalty from you for that, and they will make your life miserable over that. So one of the things I will tell you is when you get information from whoever it is that does your documents, and they tell you to sign something, they tell you to sign it by a certain date, you need to do that, and you need to keep a copy of that. And particularly if they don't ask for a copy back, that means that they're expecting you to have it. And if you don't have it, there's going to be hell to pay when you get audited. So that's a key issue that you can handle very easily. Sign the stuff that your administrator sends you and keep it. Keep it in a file folder, keep it in a 3-ring binder or something like that. That will always be an issue, and it's low-hanging fruit to the government. After that, it really sort of varies. They're obviously going to look to make sure that people who are eligible for the plan get in. They're going to look to see that if you have a 401k plan and nobody is deferring, they're going to wonder whether you're telling people about the plan. And you need to tell people about the plan. We had one case where the third party admin, oh no, actually it was the auditor. It was the CPA auditor noticed that hardly anybody was participating, and she went to the HR director and said, why is nobody participating in this plan? And the HR director said to her, I really hate these plans, so I keep it on the down low and I don't tell anybody about it.
Oh, no.
Not a good result. So they want to see that people are in the plan, that people are participating. If they see another big area that I will mention is that if all of the rank and file employees are invested in a selection of mutual funds that the plan makes available, but the owners of the company or the executives are all invested in self-directed brokerage accounts, they're going to think that that was not offered to the rank and file. And that's a big issue. So you want to make sure that you have records that show that features are offered to people and they chose not to use them. So those things are really important.
Yeah, that's interesting. We deal quite a bit with the self-directed brokerage accounts, and it's that fine line. It's sort of a big gray area of making it known it's available without marketing it, and that's where we see a lot of people saying, it's in the document.
Account wanting a self-directed brokerage account, right? That just doesn't make sense. But you really want to make sure that you've offered it to people. It should be in the SPD, and you should have it in PowerPoint slides when you do presentations to the employees, just so that you can show, no, we told people about it. They just chose not to do that.
Yeah, gotcha. Okay, thank you for that. I will let us move forward. And Kevin, I think you're going to take us away.
So yeah, I mean, I think this slide goes back to the couple previous slides that the IRS is really looking at your internal controls. So they want to make sure that you have, your procedures, documented policies in place, and that the activities of your administrator and your plan sponsor ensure that you're compliant. So, You know, Eileen, can you kind of talk to us about, you know, what procedures, policies, and even, you know, why are they looking at your computer program? So can you dig a little deeper on that?
Sure. Well, so, it used to be that when the IRS talked about, do you have proper procedures, we would all say, well, we have a third-party administrator, and the third-party administrator has procedures, so we're good to go. The IRS doesn't accept that anymore. They want to make sure that plan sponsors are doing their part of the process appropriately. So internal controls is an auditing term, and the IRS people are almost all accountants, and so therefore they use auditing terms. But what it basically means is that you have systems in your office that help you do things correctly. So let's say, for example, that you are determining the payroll that you're going to report to your third-party administrator, or you're doing the calculation of people's salary deferrals for the 401k plan. They want to know that you have some sense of what compensation is deferrable and how you calculate that kind of stuff. Now, it can be that you have just notes. It could be that maybe your third-party administrator has provided you with some information, you kept it somewhere, but just some sense of, if I were to say to you, how do you know what percentage, what compensation you apply that deferral percentage to, that you would have some impression about that. So as plan sponsors, you want to make sure that all of your questions have been answered, that you're not making assumptions, because lots of times assumptions really do make an ass out of you and me, that they really they take you down a wrong path. Another thing that I think is really helpful, that's really easy to create and then produce as an illustration that you're on top of things, is to have a phone tree, so that you have a form that maybe sits with whoever does your benefits administration in your office, that says, if we have a question about investments, call Joe. If we have a question about the deferrals, call Sam. If we have a question about payroll, call, but the point is that it's there so that if that HR person who is in charge of the plan is not there and a question comes up, somebody knows who to call. So something like that, I think, is a helpful thing to show the IRS that you have. Anything that shows that you are giving this some thought and some diligence to show that you're doing the plan correctly. If you are completely bumfuzzled about what it is that you're doing with this plan, it's time to talk to somebody. Go to the trust guys that are on the phone, go to your TPA, go to your lawyer, go to somebody and say, I am totally underwater as to what I'm supposed to be doing here. Help me understand my part of the job.
And can you
Yeah.
jump into that last bullet, because that one's kind of, I've read that last bullet several times. It's kind of confusing to me. So can you kind of dig in there as well?
Before I do that, let me mention one other thing, and then I will. Our firm has a checklist that we can make available to the guys at the trust company, and they can make available to you. It's got about 150 items on it that go into administering a 401k plan appropriately. And then they've got columns going across on the x-axis that shows, TPA, plan administrator, trustee, et cetera, et cetera, et cetera. And the idea is that you check the boxes for who it is that's doing each of those tasks. And if you are the plan sponsor and you have boxes with no checks by them, that's your responsibility. And this can help you understand, first of all, what your responsibilities are and whether or not you're doing them correctly. And secondarily, if you've got the same boxes checked 4 times by different service providers, you might have some duplication of services there. So if you want to have that, like I said, I'll make it available to Zach and to Kevin, and they can make it available to you to help you understand who does what on your plan and what your responsibilities are. Okay, so when the IRS audits you on your plan, if they find that the plan is out of compliance, they will offer you the ability to enter into something called a closing agreement, where they basically say, we will let your plan remain. We're not going to tax people. We're not going to do anything else. You're going to fix the mistakes that you made, and then you are going to pay us money for giving you this opportunity to keep your plan compliant. And that money is called a sanction. And when the IRS figures out that sanction, it's a negotiated amount. Whoever's representing you on the audit will negotiate with the IRS as to that amount. There are factors that the IRS is supposed to take into account. And how compliant your plan is generally is commonly or is one of the factors that they take into account. So if you show that you have internal controls and this was simply an error that was missed despite those internal controls, that helps lower your sanction.
Excuse me.
Eileen, on the internal controls, we've heard some of this year, but from the IRS standpoint, how important is a committee versus a single person running this?
It depends upon the size of your company. If you have a firm that has a couple of hundred employees and you've got an HR director and you got a benefits person, having a committee to oversee the plan might be a good thing. It might give you that input from people of various general areas, various talents that will help you make sure your plan is running correctly. If, on the other hand, you have a smaller company that's very closely held, for me to have a committee of me to tell me what I'm supposed to do, that's a real waste of time. So, like my firm, we have 12 employees here. So to do a committee, basically we would end up with a committee made up of half of our employees. It's just ridiculous. My partner and I are the ones who make those decisions. So it really doesn't, it doesn't make any difference whether you have a committee or not. It's a function of whether or not the plan is having the attention given to it that it should.
Got it. Great.
And I like this slide. This kind of makes me feel like, back in college when you would answer a question partly correct and you'd get a little partial credit. So this implies that you're going to get partial credit if you are maybe a little out of compliance. So, explain that to us.
Yeah, the IRS is looking for people who try to be compliant, who are doing their best efforts. And if they have an indication that you were on the right track, but there was just a mathematical error made or something slipped through the cracks, that puts you in better stead with them than if they believe that you were just flouting the law, or you didn't care, you didn't pay attention to this, or you don't know what you're doing and you haven't even tried. So by giving attention to the plan's compliance, you are giving yourself a foot forward with the IRS. That they will treat you better, that your sanctions will be lower, that they will tend to correct things outside of caps so you don't have sanctions at all, because they believe that you're doing the best that you can.
You may have answered this earlier, but it really is starting to feel like the IRS is a lot nicer than the DOL. So, are we plan sponsors more likely to be audited by one or the other? Did you mention DOL earlier?
Well, audits by the IRS are more common, but audits by the IRS tend to be less frustrating. I will tell you that, the IRS finds that people in your plan are not getting money that they're entitled to. They will insist on those people getting money. Let me be clear about that. Sure. If you have employees that were supposed to have salaries deferred and you didn't do it, or get contributions and they didn't get those contributions, the IRS will make you make that right. What the IRS generally doesn't do, that the DOL does, is they don't necessarily nitpick minor items. So like the Department of Labor examiner might say, I want to see every single payroll that you've done over this 1 year period of time. And then they'll look at every single payroll. And if you were 1 day late getting that money into the plan, they'll make you calculate what the interest was and get it into the plan. And that, they will nitpick really minor things like that. The IRS doesn't tend to do that. They tend to look for, did people get what they were entitled to? And if they did, we're good to go.
Okay, gotcha.
And I think we hit on this earlier. This is again that cap process. So a closing agreement with a agreement to pay some type of sanction. Can you tell us what a typical sanction might be?
Sure. And again, it varies. The sanction is supposed to be based again on many factors. It's supposed to be a negotiated amount. There is a voluntary program that the IRS has called the Voluntary Compliance Program that you can take a problem into the IRS voluntarily and fix it. And there is a fee for that. And that fee runs from $1,500 to $3,500. I will tell you that the sanction that the IRS is going to charge you in a closing agreement process will never be less than the VCP fee. Because they want to encourage people to do things voluntarily, and so they will reward you for doing that. And if they catch you, they will definitely pay, make you pay a price. My experience is that very few sanctions go over $30,000, and that's just sort of again, if I was dealing with a $5 million or a $5 million plan, it's one thing. If I'm dealing with a $500 million plan, it's something else. But generally speaking, the IRS understands that 5 figures and the low 5 figures tends to be painful enough to small business that does what they need to do. Sometimes it'll go under 10,000, but I would say that 10,000 to 20,000 is usually the sweet spot of what sanctions will be. Let me also mention that there's a category of errors. If your error is either insignificant, and that's a term that is open to interpretation, or if it happened within 2 years of the end of the plan year, or I'm sorry, if it's corrected within 2 years of the end of the plan year in which it occurred, then you can self-correct that without a sanction. And if the IRS finds one of those kinds of errors in your plan, they will let you fix it outside of CAP. So let me just talk about one other thing before we leave this slide, and that is what happens if you won't enter into a CAP? So the IRS says, we found this mistake in your plan. We want you to pay a $10,000 sanction and enter into this agreement with them. And you say, no, I'm not going to do that. What the IRS can do is something called disqualifying your plan. And what that does is it converts your plan into something called a non-qualified plan. And what that does is it means that all of your contributions for your open tax years will either be taxable to your employees or will be disallowed by the government. So if you made a $100,000 contribution in a year, to the extent that that contribution went to vested benefits, that will get taxed through to the employees. To the extent it wasn't vested benefits, you'll lose your deduction on that amount. Secondly, your entire trust income will become taxable at trust prices. Your trusts are tax exempt currently, so you don't pay income tax on the income in the trust. If your plan's disqualified, you have to pay taxes on the income at trust rates. And the third part is anytime anybody took a distribution during the open tax years and rolled it over to another plan, that rollover will be disallowed and they'll have to pay taxes on that full amount of that distribution. So that is like the nuclear bomb of retirement plans. I've been doing this since I was, believe it or not, 20 years old, which was not yesterday. I have never seen a plan disqualified. Okay, I've always been able to preserve the qualification of a plan. The only place I see disqualified plans is in court cases that I read. And so it's just never a good thing to have a plan disqualified, or almost never a good thing. And so you almost always want to enter into a CAP to preserve your plan.
There's a word that stands out to me on this page, and it's on the last bullet. It says pay a sanction negotiated with the IRS. And so are there plan sponsors out there who try to do this on their own, or do you feel like throughout this process they find somebody like you to kind of take over the step?
Well, I know that there are people who do it on their own, and I know that there are people who try to do it on their own until the sanction comes back and it's more than they want to pay, and then they get me involved. Again, I strongly recommend you don't do this on your own, but you're certainly legally, it's within your rights to represent yourself through this entire process.
Got it. Side note, does anybody else feel kind of creepy seeing two hands shaking at this point after 8 months of not being able to touch each other, or is it just me?
You should be touching elbows instead, right?
Exactly right. Okay, so we touched on audit corrections, but do you want to walk us through this, Eileen?
Sure. So one of the things that I had mentioned is that the IRS has sort of this correction, process. The phrase up in the first line, EPCR, stands for the Employee Plans Correction Resolution System, which again is called EPCRs by the government. This is a revenue procedure issued by the IRS that tells you, it's basically a cookbook for how to fix plan problems. And under that procedure, basically you can correct things on your own. You can self-correct things as long as they're insignificant or within a certain period of time. And so one of the questions the IRS is going to look for is, how come we found this and you didn't? And again, this goes to how compliant your plan is. Are people doing things? If you find a mistake before the IRS does, then you have a couple of options, or even if they find the mistake, you have a couple of options. You don't necessarily have to concede to the IRS saying that you made a mistake. So the first option is you're in the wrong. You know you're in the wrong. So you admit that you were in the wrong, you cooperate with the IRS, you fix the mistake, and you move on and you enter the CAP program or whatever. And that is probably the most common result in an audit situation. But the second possibility is that you can argue that what they think is an error didn't actually occur. And sometimes their facts are just wrong. Sometimes they're given the wrong impression by somebody saying something. Sometimes they look at something and they misinterpret it, but there are just times where they think something happened and it didn't happen. So an example might be somebody made an election to change their deferral percentage, but they don't see any evidence of that. So they think that you changed the deferral percentage on your own initiative, which was wrong. And so you find evidence that this person actually did make this election. You're able to get the phone call from the record keeper that, the recording of the phone call where the person asked to have this done, or you find an email from the person where they asked to change the deferral, or something that convinces the IRS that whatever mistake they think made didn't really happen. And the final one, and this is where an advisor handling this audit can be very helpful to you is sometimes you can tell the IRS that they are just wrong, that what they think is a violation is not a violation. And we've had some success on this on a couple of occasions where the IRS came in and said, you need to have X and you don't have X, so therefore it's a problem. We've said, show us in the law where it says that you need to have X. And they can't do that. And then we say, well, in that case, it's not a violation. Other situations are where they think that the law provides that if your plan has such and such a provision, then something else has to happen, and that they've been wrong about that. So that's a good time to have somebody who's knowledgeable about the law, because they can go back to the IRS and argue that this was not in fact a violation. And there have been times historically that I've been working on plans where the IRS has, as a body, taken a position that the retirement plan community fights with all their efforts, and some of those things have gone to tax court and the IRS has been proven wrong. So it is not unusual necessarily, it's not common, but it's not unusual if the IRS takes an incorrect tact on this stuff. And so you may have options that you're not really thinking about.
Got it. And you mentioned earlier the voluntary correction program, and I think was the range you gave kind of $1,500 to $3,500? Is that what I heard?
Yes.
Okay, and so the sanction amount, we've got that in our mind, we've got this cap in our mind. So how does this all play out?
Well, again, these are the factors that the IRS looks at when they're determining the sanction amount. And I will mention another one that's not on here that is one of those things that they don't admit to, but it's really true. First of all, they'll look at how many employees were affected. And they'll look at that from a standpoint of not just the bold number of how many people were affected, but what that percentage is of the total employees involved. If you've got 300 employees and 2 people are affected, that's not very significant. If you've got 3 people in the plan and 2 people are affected, that may or may not be significant. The IRS understands that smaller plans, it's hard to have an insignificant percentage of things as you don't have a whole lot of people involved. So they don't look upon significance in quite the same way as they do with a larger plan. They look at how many non-highly compensated employees are affected. Is this really hurting the rank and file, or is this just a situation where we're really impacted high-paid people? The IRS doesn't really care about protecting high-paid people. They care about your rank and file. When I talk here about a demographic failure or an employer eligibility failure, a demographic failure is a situation where the plan operated entirely correctly. But the problem was that it failed non-discrimination testing or something like that. So the plan did what it was supposed to do. It's just that we have a problem with the way the numbers worked out. An employer eligibility failure is where a type of employer is sponsoring a plan they're not permitted to sponsor. And that really affects 2 kinds of plans. 403B plans have to be sponsored by public schools or 501c3 nonprofit organizations. What we see is that sometimes a 403B plan is sponsored by a nonprofit organization that is not a 501c3 organization. So that would be one of those situations. The second situation where you see employer eligibility failures is when you have governmental organizations sponsoring a 401k plan. That's not permitted. So you'll have some, small department of some small city that decides that they're going to adopt a 401k plan and they can't because they're governmental. If it's one of those 2 failures, the IRS treats it differently than the other kinds of failures, like document failures where your plan document hasn't been signed or amendments haven't been done, or where the plan is not operating according to its terms. So they look at that. The length of time the failure occurred. Did this go on for years or did this happen just one time? How did it happen? Was it something slipping through the cracks, or was it that we didn't care about being compliant? And then finally, there's a thing called the maximum payment amount. And what that really is it's the amount of tax that you would pay if the plan were disqualified. They look at that as sort of an upper limit as to what they would charge. Sanctions never get anywhere near the maximum payment amount. So that is actually almost an irrelevancy with the IRS. Now, the factor that's not on here that I will tell you about is that the IRS has, they meet nationally and they talk about the sanctions that they're charging. They are looking to have some sort of commonality throughout the United States about sanctions so that we don't have a situation where a problem happens in California and the sanction is significantly different than if the problem happens in New York City. And so the IRS will have in mind what a sanction is going to be before they even look at these factors. They know that, hey, if you have a plan document problem, we're going to charge you between X and Y, and it's just within that range that we're going to be judging on these factors. So that's normally the way it works. By the way, they will not tell you X and Y. Okay, and I will tell you the other thing. I try to get the IRS to give me a sanction first, so I'm not bargaining against myself. They generally don't want to do that either. They want you to throw out the first number. And it's truly a negotiation. I mean, you'll throw out a number, it will be a low ball, because that's what I do. If you're going to ask me to give you a sanction, I'm going to tell you, I want a $3,000 sanction, or I want a $5,000 sanction. And they'll do their, kind of like the car salesman thing. What, are you kidding me? We're not going to, you're not even being serious here. But then they'll give you another number, and we'll end up somewhere in between. And it really is almost like buying a car.
That sounds miserable based on my car buying experiences, but but we have people like you for that, so that's great.
There you go. Yeah.
Hey, we've covered a lot of questions that have come in. Here's one that just popped up, and I think it's a good one. It says, are IRS sanctions paid to the plan and allocated to the participants, or simply to the government as a penalty?
Such a good question. No, that's paid to the government, and it has to be paid by the employer. It cannot be paid by the plan. And plan corrections cannot be paid by the plan. So let's say that, the IRS audits your plan. They say you should have made contributions to these 4 employees, and the total cost of the contributions is $10,000. You can't just take that out of other people's accounts. You have to have the employer put in new money for that.
Got it. Okay.
And by the way, the sanction's also not deductible. Just to mention that as well.
But you're saying the $10,000 that is owed to the employees will go into those employees' accounts. Then there will be a sanction above and beyond, maybe a $3,000 or $5,000 that's going to be paid directly to the IRS by the plan sponsor.
That's absolutely correct. Yes. And the $10,000 you put in for the employees, that is deductible because that's a contribution. But the sanction you pay to the government is not deductible and has to be paid by the employer.
Okay. Great. And I think we're going to wrap up with this and maybe a question or two, Eileen, but sort of a summary, I guess, is what this will be, is what to do if audited.
So again, the first thing is really true. Don't panic. Nobody's ever died from an IRS audit of a qualified plan. Again, the IRS recognizes that qualified plans are good things. This is not the same as any experience you might have had when the IRS is auditing your 1040, okay? They don't think that there's any tax evasion going on here. They're not looking for fraud usually. They're looking to just make sure this plan is operated correctly. So you don't have to give this the same amount of intestinal nausea that you might give to a regular 1040 audit. Again, I recognize really strongly that you get somebody trusted to help you prepare for the audit and to handle the audit for you. If you don't, at least get their advice. Get your documents together, make it as coordinated and as reasonable as possible so it looks like you've got your act together. This is an interesting question. There are people out there who think that sort of if you're representing somebody in an audit, you should be adversarial, that that's part of your job. That's a real big mistake. You want to be polite. You want to be nice to these folks. And I will tell you that you can build relationships with these guys that will help you in the future. We have a bunch of auditors that, when we have a question, we call them because we have a good relationship with them. And you as a plan sponsor, you could have that kind of relationship with a former auditor as well. So, on the one hand, I mean, you're not going to invite them to your home for dinner or anything, but the point is that you do want to be nice and you want to be polite and you want to make sure that they know that you're being cooperative with them and that you're not being adversarial because they're people too. Oh, I have a great story. I just want to tell really quick about that. In the list of people who think that you need to be adversarial, there is an urban legend. I'm originally from Los Angeles, and this is an urban legend in Los Angeles about a third-party administrator who is sort of a non-likable guy. And the word is that he got angry with an IRS agent one time and actually pulled a gun on him. And the next thing that you saw was him being carted out by the police. I can say unequivocally that the thing you don't want to do in an audit is pull a gun on the auditor. That would be bad. I know that we're in sort of the South here and guns are a whole different thing, but I'm telling you, even here in the South, don't pull a gun on the auditor.
What was higher, his personal penalty or the company's penalty?
Again, the legend, I don't know all those things, but I'm sure it was not a good thing. And I'm sure getting cooperation from the IRS in the future would have been a very difficult thing for him.
Absolutely. So I think we've rolled through most questions. I did have one I did not get a chance to cover yet, and pretty curious about this. How will the election change IRS audits, if at all?
Yeah, I have never really noticed a difference in the IRS auditing process from president to president and that kind of thing. I mean, obviously, the commissioner of the Internal Revenue Service is an appointee of the government, but this tends to be pretty far down the chain, relatively speaking, and so we don't see a direct difference. The one exception to that is when there was that scandal at the IRS about them denying tax exempt status to various organizations, theoretically based on the political standard. The tax exempt organization audit group is in the same group as the employee plans audit group. So a lot of the people got shuffled around that year. A lot of the top people ended up having to resign. And even if they weren't directly related to the scandal, it was just that there was a lot of house cleaning. So I saw effects of that, but that's the only time that I've ever seen the national election have any real effect on the IRS. It has a much stronger effect on the Department of Labor.
Right. Yeah. And right. I mean, right now, Kevin may have asked this earlier, but just one last question of mine, I guess, is the pandemic that we're in, and I assume that a lot of these audits have gone virtual. Is that the case, and is that something you think will continue?
Yeah, and we found that a lot more audits were happening through the email system and things like that than had been done before, even before
Okay.
I will tell you though that the IRS will commonly want to do an interview with the business owner, and they will commonly want to see the business location. And the reason why they want to do the business location is that, let's say that they're auditing a plan. Let's say, it's Eileen Ferenzi, a professional law corporation or whatever. And I show on my 5500 that I've got 2 employees, me and my secretary or whatever. And they come to my place of business and they find out that I'm part of mega law firm. Okay, by coming to the business, they see things like that they see that you've got a factory that's got 50 employees in it, and none of those people are in the plan and stuff. So there will be times that they will want to actually go to your facility to see things. Other than that, they commonly will handle things at your advisor's office, or they will commonly do things through the mail.
Okay. Got it. Eileen, you have been wonderful. Thank you for doing this. For those of you who weren't familiar with Eileen before, Google her. She's all over the place right now for what she does. Her information is here. By all means, if you have questions about your own plan, please feel free to reach out. But Eileen, thank you so much. Kevin, obviously, thank you to you as well.
I really appreciate this, and I hope everybody got good information.
I think we all did. I certainly did. And happy Thanksgiving to you all, and we hope to see you soon.
Thanks.
Thank you, guys.